Good morning, students. My name is Selma Kambode. I'll be your tutor for school subject accounting for 2020. Welcome to accounting. I hope we are all going to have a fruitful journey and a productive career. Today we are going to talk about ledgers. Alright, before we start talking about the ledgers, we have to start with the term posting. What is posting? Posting means, so because everything in accounting we have to post to the ledgers. So when somebody asks you what is posting, what are you going to say? It simply refers to the transferring of accounting information or transactions from the books of first entry to the ledgers. Alright, so we have the books of first entry, the cash book, the petty cash book, the debtors journal, the general journal. So those information that we get from those books of first entry, we are now going to transfer them into the ledgers. Now, what is this ledger? A ledger is a name given to a collection of all business accounts. It shows all the financial activity for each account open in the subsidiary books. So when we are talking about subsidiary books, we are talking about the books of first entry that I just mentioned earlier. It shows the balance of each account over a given period of time. Now, what are the importance of a ledger? They help us to provide up-to-date account balances to enable us to prepare the trial balance and the financial statements. They are used as a monitoring tool for movement in each of the business accounts to assist in decision making. They provide all the financial activity for all the business accounts over a given period, which make it easy to trace down the transactions thereof. There are now three types of ledgers. We have the debtors ledger, we have the creditors ledger, and we have the general ledger. Okay, the debtors ledger is the one responsible for tracking down all the debtors' individual account. All the people, all our customers that have bought goods from us previously that they didn't pay us yet, we are going to record these debtors in our debtors ledger, because the debtors ledgers only deals with debtors individuals accounts. Then we have the creditors ledger. The creditors ledgers is where we record all our suppliers to whom we have bought goods on credit. We haven't paid our supplier yet. Then we have to take record of all this information in our creditors ledger. Now if we have the total balance of debtors ledger this side, and we have the total balance of the creditors ledger here. This information, the balance, will be the one which we are going to transfer to our trial balance, like I mentioned already when I was defining the importance of the ledger. Okay, then the general ledger. This general ledger is the one responsible for recording all other information which doesn't fall under the debtors ledger and doesn't fall under the creditors ledger. These informations are assets, capital, drawings, liability, income, expenses account. All these accounts are the ones that are posted into the general ledger, except for the debtors information and the creditors information. Those ones are posted in the debtors ledger and the creditors ledger. Alright, this is a format of a ledgers account. We have the T account and we also have the running account. Okay, the T account, T, this is T, okay, which have credit side and debit side. Okay, let's say for example you are dealing with the debtors ledger. Debtors ledgers. Debtor is an asset. This is an asset. And I already spoke to you that assets always increases on the debit side and they decreases on the credit side. This is the T account that you are going to use. If you are doing the creditors ledger, creditors are liability because these are people that we owe money. So therefore, creditors increases on the credit side and they decrease on the debit side. So you should just know how to post your information. So this is what we talk about posting. So all the information you'll be posting. If you are dealing with the creditors information, if your creditors are becoming more, then you have to record them, post them on the credit side. If they are reducing, like maybe you are paying off some of your creditors, then you start recording them, posting them on the debit side. Okay, then the next example is the running balance account. This one, you just write the date, details, for your number, debit, credit, and the balance. Okay, this is almost the same as the T account, but here, let's say for example, this is a debtors ledger. Debtors ledger. Okay, so Selma bought goods on credit from us. So we are going to say sales. For your number, you put the for your number here. The date you write, when was it, when did that transaction took place. Then you say how much was this good sold to Selma, 500. Here you put nothing because it's a debit side, because debtors are increasing on the debit side. Can you see I just recorded on the debit column, and then here 500 on the balance. Okay, then the next day Pandureni bought goods on sale from us worth 1,000 Namibian dollar. No credit, this is 1,000. Okay, so at the end of the day, at the end of the month, this is going to be a balance, total balance of 1,500. All right, so let's say in the next month, Pandureni came through, pay with cash, 700 to us. Where would I record this 700? Because now our debtors are going to decrease. When did I say debtors are decreasing on? They are decreasing on the credit side. So this amount is no more going to be 1,500. It's going to be 800. You see? That is the running balance. If you are going to deal with the creditors ledger again, so when you buy goods on credit, you write purchases here. Let me give you an example of a creditors journal, creditors ledger. Okay, you bought goods on credit from a supplier called Penge. Okay, then you are going to say purchases. Then what is the amount of the goods that you bought from a supplier Penge? You bought good worth 10,000. You see why I'm recording on the credit side is because creditors increases on the credit side, and then the balance here will be 10,000. All right, now if you decide that you in the next week you got money from in your business, now you are going to pay to issue a check to Penge to pay off your debts. Now the creditors are decreasing on the debit side, so you are going to say 5,000 check to be paid, debit side to be paid here, credit nothing, then the balance will be 5,000. So that is the posting using a T format, and also the second one, running balance. This is how we do it. Okay, now we are going to talk about the petty cash book. What is a petty cash? Even the word itself, petty, it means small. All right, in accounting there is a cash book. Don't get confused. A cash book is the one where we record all important transactions with payment of huge amount of money. Okay, but when we are talking about a petty cash, we are only talking about when in a business does payment of little money, less than 100. Okay, That's why we have to create a petty cash. Do you know why? The reason is because we do not want to if we don't have a petty cash and we use a cash book to record all this petty information, our cash book is going to be full of information, and then we are not going to, we will get confused, we don't know what is happening. So to avoid all this confusion, we have to come up with a petty cash which only deals with petty issues or petty or small payments. Okay, a petty cash book is a book needed to record small amount of cash received and paid out of the business. Okay, as the name suggests, this is a small cash book used to record cash transaction with a very small value. Cashier, a senior staff who draw up the main cash book. Petty cashier, a junior staff assigned to draw up the cash, petty cash. What are the advantages of a petty cash? Like I explained already, the task of handling and recording small cash payment is delegated to a junior staff. It minimizes number of entry in the main cash book, like I mentioned, and the ledgers. It saves the main cash book and the ledger from being overloaded with many separate small entry. It also enables the chief cashier to concentrate more on cash transaction, more important like the cash book. Okay, what is the Impress system? Impress system is a system whereby the amount available for petty cash payment is fixed every month. Let's say, for example, every month the business have a petty cash of 300. That is the fixed amount allocated to every month. So every month we have a 300. This is what we call Impress system. The cashier ensures that the petty cashier has a fixed amount cash enough to meet the petty cash needs every month. So this 300 must accommodate all the needs during that month. Let's say, for example, we are now in November, and then we are given 300. So all the petty cash must be solved with this 300 Namibian dollar. All right. For example, the petty cash here will keep 200 in her drawer. The accounting will complete a petty cash voucher and give it to the petty cashier with any receipt as a proof. The petty cashier will reimburse the accountant. The cashier will make sure the petty cashier has 300 and on a monthly basis. Okay, these are some of the expenditure which are also which we are going to use in our petty cash. We have sundry accounts, we have sundry expenses, we have postage, we have stationaries. So when we are talking about sundry accounts, you should know, when you are going to do your petty cash, you should know which one of the transaction falls under postage, which one falls under stationery, which one falls under sundry expenses, and so on. So when we are talking about sundry account, other specific account whose column is not specific in the petty cash book, example, wages, donation, cleaning material, all the general expenses, they must be recorded or posted under the sundry account. What about the sundry expenses? This is expenses such as tea, coffee, sugar, sweet, birthday gifts, etc. Postage, what should we see under the postage column? This should be parcel, telegram, stamp. What should be under stationery? It should be pen, pencil, envelope, rubber, right? So this is an example of a petty cash, okay? We have a debit side and we have a credit side again. All the payments or the money that is coming in the business are to be recorded on the debit side, and then all the payments are going to be recorded on the credit side. As you can see the format here, you write the date, the details, what is happening, what was paid, the voucher number, total, and then this same amount again, you are going to post it under the correct category. If the company bought pencils for the office, then that is stationery. Then you record, we are going to say the 1st of November 2019, voucher number 2, total, how much was the pen, how much was the 50 Namibian dollar? Then you put under stationery 50 Namibian dollar. Then you are done. Okay? The same applies to any other transaction that you're going to get close to. Petty cash can be restored at the beginning. Petty cash restored at the end. This is important information that you also need to read. Okay, now we are going to talk about adjustments. We are going to talk about adjustment. 1. Accrued income. What is an accrued income? Accrued income, these are payments that we are still expecting from our debtors. Let's say, for example, we sell goods to our customers, then they're supposed to pay us in the month of October, end of October, but they didn't. So they are owing us. Then accrued income is a debtor which become an asset, and then you already know accrued income are increasing on the debit side and decreasing on the credit side. It's recorded as an asset since money is owed to the business for goods delivered or services rendered before cash is received. This we have delivered our services to our clients, but our clients haven't paid us yet. So they are owing us. So they become our debtors. That's why I'm saying accrued income is an expense. Then we have the next one, which is accrued expenses. Accrued expenses. What are accrued expenses? Accrued expenses, this is when accrued expenses is a liability. Why? Because accrued is recorded as a liability since money is owed by the business for good delivered or service rendered before cash is paid. Accrued expenses, let's say for example your business was given some items on credit, or maybe a supplier came to your business to fix something, but you haven't paid them, the supplier, yet. So you are owing the suppliers. That's why this one become accrued expense, and it's a liability because you are owing these people, and the liability you know how to treat them. Okay, as long as you know accrued income is an expense, it's an asset, accrued expenses is a liability, then you are good to go. Another concept is which we call income received in advance. Under what accounts is the income received in advance? This is a liability. Why? Because, let's say for example, you are rendering services. Okay? Now that you are rendering services to your customers, some of your customers have paid you in advance, but you haven't delivered the services to them yet. So who is owing who? It's you, because your customer have paid you already, but you haven't delivered the services to them. So you are owing your customers. Then this become a liability. Alright. Then the fourth one is accrued income. Accrued income, this is when your business, no, not accrued income, but accrued expense, accrued expense. Accrued expenses, to me, this is an asset. Why? Because it's recorded as an asset since cash was paid before goods were delivered or services were rendered. So when your business decided to pay off quickly, there are suppliers, but they haven't received any work from the supplier yet. So the suppliers are owing your business. So this become assets. So you just know accrued income and accrued expenses, those are assets. Accrued expenses, income received in advance, those are liability, and then you should know how to treat them. Okay, so this is a very good. You should master this when you are dealing with a ledger now. Accrued refer to the period they were incurred during belonging income account. All right, expenses are amount, and so on. should read this. Income statement. How are we going to treat this in the income statement? Number one, when we are dealing with the amount accrued, we add to the amount given before the adjustment. You know, when you are doing this financial statement, you are usually given a balances from the trial balance and later adjustments. Those adjustments are the ones that are having either accrued income issues or accrued expenses issues, and so now this one is just a guideline to guide you. Okay, now if you are working on the income statement and you have an accrued amount, all the accrued amounts, you add them to the given information before the adjustment. Okay. Number two, subtract the amount prepaid and received in advance. So everything that that is stated in your in your additional information, and it's an amount which is paid in advance or received in advance. So subtract it from the information in the trial balance to get the correct amount. How do we deal with the balance sheet information? The same applies. All accrued expenses under current liability, accrued income under current assets. We have prepaid expenses under current assets, income received in advance under current liability. So you should know. Accrued expenses under current liability. This is what I was explaining already, so that you know. Okay? To show the... Now we are going to talk about bad debts, provision for doubtful debts, and so on. Bad debts. What is a bad debt? A bad debt, remember when we are talking about debtors accounts, okay? There are times when customers are coming to buy from us on credit. We allow these people to buy goods from us on credit, okay? But there is no guarantee that these people are going to pay us the full amount that they are owing us, okay? It can be that this person died, is declared as insolvent, is nowhere to be found, disappear. So the amount this person is owing us is the one that we have to write off as a bad debt. So bad debts are the money that we are unable to collect from our debtors anymore, okay? While bad debt recover the money collected from a customer whose account was previously written off. It can be maybe in 2020, after we have written off somebody as a bad debtor, in 2021, that person reappeared again and decided to pay us. You see, that account was previously written off. Now the person came through. So now we are going to say, this is an income, which we are going to say bad debt recovered. Or bad debts are expenses, okay? Provision for doubtful debts. This is an estimation of how much we are going to lose money through debts. Okay, when we give out debts to our customers, we must also make a provision, an estimation that okay, we don't really expect 100% payment from our customers. No. Maybe only 90% of our customers are going to pay us, those who have given goods on credit. Meaning, this 10% should be written off as this is a provision. So provision is an estimate of debts that are likely to be turned into bad debts in the future. So in business, you have to be realistic. You will never get 100% payment from your customers. So you must also make provision. What if they don't pay in full? So the 10%, this is what we call the provision for bad debts. Okay. Reason for creating bad debts: a debtor is declared either insolvent, unable to pay his debts. A debtor cannot be traced. The person has disappeared. The debtor's died. The debtor has gone out of business and it's bankrupt. There's nothing you can do. How are you going to get this money? So these are ways now of minimizing bad debts. So number one, charging interest on debtors on overdue accounts. When they don't pay on time, we are going to charge them. Send out invoices and statement to account on a regular basis to remind them that they owe this much. Give discount to debtors to encourage them to pay on time. If necessary, also only sell on credit to customer with proven credit history. Sometimes you have a credit history of your our customers. You know your customers very well. You know that customer A doesn't pay on time. Customer X, this one always pay on time. So you have the trust in the customer B. So avoid selling your goods to customer that really don't really pay on time. Investigate customer credit worthy to ensure their credibility to the pay their debts and stuff. Sometimes also before you give out on credit, you should also understand and investigate the credit worthy of your customers. You don't just trust anybody coming and say, yeah, you are going to buy things from a shop on credit. No, investigate these people first. Understand their credit worthy first before giving out anything. Okay, bad debts, like I say, is an expenses, and expenses are increasing on the debit side, and then when they are written off, they decreases on the credit side. Bad debt recover, that is an income, and income are always increasing on the credit side, and then they decrease on the debit side. Okay, you should also master this income statement. How we got the bad debts? It is in the income statement as an expense. Bad debt recover is in the income statement as an income in the balance sheet, and the bad debts subtracted from debtors. Okay, don't forget that one. How are we going to record our bad debts in our balance sheet? It's always subtracted from the debtors, because this money is not going to be recovered anymore. So take it off from the debtors. And bad debt recover under asset, and bad debts recover to cash and bank. So this is money coming in. So your cash and your bank will be increasing. That's how you treat them in the balance sheet, and that is how you treat them in the income statement. The provision for doubtful debts. Profit and loss account record the full amount as an expense. Alright? In the balance sheet, we subtract the full balance from the debtors. When our provision for doubtful debts are increasing, how are we going to record this in our income, profit and loss accounts? We are going to record the difference as an expense when our provision for doubtful debts is increasing. While in the balance sheet, we are going to subtract that amount from the debtors. Okay? In case whereby our provision for doubtful debts is decreasing, so we record this one, the difference in the profit and loss account, as an income, while in our balance sheet we subtract this full balance from the debtor. Now we are moving on to depreciation. What is depreciation? Depreciation is a loss in value when the assets, non-current assets, are decreasing in value as they have been used in the company or in a business for some times. So I'm going to give you an example, a practical example of company A. Company A bought a vehicle in 2020 worth 300,000. This is the value of the vehicle that was bought in company A. So in 2020, the value was 300,000. So it means after 5 years, because the expected life span for this vehicle is 5 years. So after 5 years, this vehicle is no more going to have the same value as it was initially bought in the business, because it will lose some value. So 300 in 2024, the value will be at 150. So the difference between the value at which this vehicle was bought against the depreciation, this is what we call, the final value, this is what we call depreciation. So depreciation is a loss in value. Anything that you are going to buy today, after some times it won't have the same exact value as it was bought at the beginning. So the difference is what we call depreciation. Okay, we also have to make provision for depreciation. Provision for depreciation, this is accumulated loss in the value of fixed assets since the date of its purchase. How are we going to treat this in accounting, in our books? We are going to debit depreciation since depreciation is an expense. Okay, and we are going to credit provision for depreciation, a contrast as asset account. What are the causes of depreciation? Physical deterioration, Some assets get worn out due to its constant use in production. Economical reasons, some assets become outdated. They are no more in fashion. People don't use such. Let's say, for example, in 2000, there were no computers. There were typewriters. So companies that had typewriters, they have to depreciate them off because now people are moving into the use of computers. Some asset may meet an accident and therefore it may get depreciated in its own value. Depleting an asset of non-renewable nature may weaken over time, such as coal, mine, oil, etc. Reason for providing depreciation: to review the correct profit and loss account at the given time. So the reason why we do the depreciation is because we want to give the true reflection of the asset value at the end of the day when we are recording in our income statement. After 5 years, for example, you can't record vehicle worth 300,000. No, because the value have gone down. If you record 300,000, you are overstating the amount. You are not really giving a true reflection of your assets. To show correct financial position of the business, to make provision for replacement of a fixed asset. There are 3 methods of depreciation. We have the straight line method, reducing or diminishing method, and reevaluation method. Depreciation is an expense, like I said, and I already explained to you how it's going to be treated. Method of distribution. Here, when we are doing using the straight line method, how are we going to calculate using the straight line method? Then we have cost of the asset minus the scrap value and the number of years. Okay? Then we get the depreciation. Or rate of depreciation, you take the annual depreciation, cost of assets minus scrap value multiplied by 100. So those are the formulas for calculating depreciation. So you can use either of the two depending to what information you are given. Method 2. Method 2 is the diminishing method. 1. Cost minus previous year's depreciation multiplied by the rate over 100 multiplied by n. N can be, if you're in the middle of the year, whereby the year haven't ended, then you can say 6 out of, if you are in June, you can say 6 out of 12, then you get the answer. If you are in May, how many months are remaining, then you can put 8 out of 12 if you are there. Net book value of an asset multiplied by the rate of depreciation multiplied by the months it used that year. So this is formula 2. Disposal of non-current assets. 3 things can happen. Sell at book value equal to selling price. Sometimes when you want to sell, disposing means to sell your non-current assets. Sometimes we sell them at the book value. Okay, so below book value and then you get a loss on disposal. Or sometimes you sell over your book value. What is a book value? Guys, book value means, let's say let me go back to the previous example. Now in 2024 we decided to sell our vehicle. If we are going to sell our vehicle below book value, it means this is our book value, 150. So when we are going to sell it below, it means we are going to sell it at 130. So we are going to make a loss of 20,000. That is what it means. But if we are going to sell our assets over book value, this is loss on disposal. Disposal. This is what I'm talking about. Okay? Why if I sell it at 160 above book value, and then the book value is 150, then I'm going to make a profit of 10,000. This is a profit on disposal. Okay. How do we treat them? Accounting treatment for disposal of fixed asset. Remove the asset from the books. Dispose account for that asset. Example, disposal, vehicle disposal, and credit fixed asset. You know, fixed assets are always decreasing on the... Okay, when this asset was bought, vehicle in 2020, We recorded bank, and this was 2020, and this is 300,000. Okay. Now in 2024, when we are going to dispose of this vehicle, again we are going to say vehicle 2024, and we are going to say bank 300,000. Why on the credit side? Like I explained earlier, assets increases on the debit side. When assets are bought in the business, you record on the debit side. When you are going to dispose, you are selling it. It will be no more in the business. It's going to be out, bought by a new person. So this 300,000 is going to be subtracted from the company's account. So it's going to be on the credit side. All right. That is what it means. Credit fixed asset with a cost price, the original cost price, and debit the disposer. How much are we going to sell it? Then we are going to say disposer. How much? Then we are going to sell it at what price? Let's say 160. And then depreciation, if there is any. Depreciation here. 150, yeah, depreciation is 150. So now this is going to be how much? It's going to be 310. 310. What is the difference? Which side? The debit side is more compared to our credit side. So we are talking about the profit of the. That's how things are done. If this side was more, then the profit will be on the debit side, then it will be a loss. Since the profit is on the credit side, this is a profit, because income, what did I say about income? Income is most increasing on the credit side. When income are on the credit side, it's a profit, it's a gain. But if this income was to be posted on the debit side, then it was going to be a loss. Okay. Fixed asset disposal. Now we are going to talk about the manufacturing account. I think we have exhausted the depreciation. Manufacturing account purpose is to show the production cost or transfer price of goods completed produced during an accounting period. These are the most important concepts that you need to master or to understand: direct material, direct labor, direct expenses, overhead factory expenses, work in progress, cost of goods consumed. Because when you are going to do the manufacturing account, these are the concept that you are going to deal with more often. Okay, a manufacturing account. Any business that produces goods should determine the cost of producing those goods, because it will help them to determine the selling price. Because for you to know that, let's say for example, I'm producing these markers, okay? For me to produce 1,000 markers, I spend 1,000 Namibian dollar, okay? Therefore, for me to determine the selling price, I'm going to say 1,000 Namibian dollar. That was the cost of producing this marker, divided how many markers did I produce? I produced 1,000 again. These are the units. Okay, now I'm going to, I want to know the average cost of one marker. So one marker cost me 1 Namibian dollar. You see, 1,000 divided by 1,000 just 1. So each marker cost me 1 Namibian dollar. So I'm not going to sell this marker at $1. I will not make a profit. I'm not a charity organization, so I will rather use add a markup. So let me make my marker 3 Namibian dollars. So every marker I sell I'm going to generate a $2 profit. So now that is the purpose of a manufacturing account, just to understand how much it costs you to produce certain products, and then you know that each of the products you have produced, it costs how much. So when you're going to determine the selling price, it's not going to be difficult for you. Okay, now when we are producing, these are the cost of production that needs to be taken care of. Now, what are direct materials? Direct materials, these are the material. Okay, this is the marker. This is plastic, ne? Yeah, this is the direct material. The material that I need to use to produce this marker. What do I need? I need ink. I need this rubber here. I need this plastic. Yeah, these are the direct material, because this material are directly. When you see anything direct, it means something which is directly related to what is being produced. Okay, direct labor. These are workers that will be directly involved in the production of this marker. Okay, direct expenses, maybe when we are going to produce this marker, we need what? We need water and electricity. All right, what else do we need as an expense? All the direct expenses that go hand in hand with the production of this marker should be recorded under direct expenses. Okay, there's factory overhead expenses. These are expenses that are there in the factory, but they were not having any relationship to what it was produced. So this is what we call overhead expenses. Overhead expenses, these are indirect expenses which do not have a direct effect of what is being produced. Work in progress, and then cost of good manufactured. Okay, this is the final answer now. Important definition. Production cost, cost of good, total cost of all good produced completed during the period. Prime cost, the sum of direct material, direct labor, and direct expenses. A prime cost, 1, 2, 3, if they are added together. Those 1, 2, 3, direct material, direct labor, direct expenses, it gives us a prime cost. Okay, direct cost, costs which vary with the volume of output. Cost which directly changes as output changes. I already explained to you that when we are talking about direct material, direct labor, or direct expenses, these three are always, when you have more, if for example we change this number of units to 10,000, it means we need more direct materials. It means we need more labor to produce this 10,000, and we need more direct expenses. But with the factory overheads, whether you have produced more output or less output, the cost remain the same. Factory overhead expenses, these are fixed costs. Let me give you an example of a fixed cost. Like factory overhead can be rent fees. When you are in an agreement with where you are renting, your factory is renting, you pay on a monthly basis from January to December, you are just paying 10,000. Whether you have produced something or nothing or more, your rent fee is just the same. The same applies with insurance. Those ones, the payments is just the same throughout. But when we are talking about direct material, direct labor, direct expenses, they changes according to the number of outputs you are going to produce. Okay? I explained indirect factory because we do not vary with the volume of output. They change. They are fixed, I mean. Factory overheads, indirect costs, cannot be incurred. Costs incurred in the manufacturing process, but they cannot be traced directly to the good being produced. They include grease, loose tool, penning balance and purchases, indirect labor, wage, salary, bonus, commission, cleaner, crave driver, foreman, supervisor, and production managers. This indirect labor, the salary doesn't change. Even if the company have produced so many markers or not, the salary of these people is just the same. Indirect expenses related to the factory, machinery, and vehicle. Rent, I spoke about rent and rates. Depreciation of factory fixed asset, insurance, repairs and maintenances, factory power, electricity, internal factory transport, loss on disposal of factory machinery. These are indirect expenses. Okay, this is an example of a manufacturing, trading, and profit and loss account. Okay, how is it done? Okay, we start with the opening stock of raw material. We add purchases of raw materials, add carriage inwards, less closing stock of raw materials. We add direct labor, loyalties, and then we get the prime cost. Okay? After we have calculated the prime cost, we add factory overhead expenses. Loose tool, rent, production manager's salary, factory power, maintenance of plant and machinery, depreciation of plant and machinery. Then we have the total overheads, which we are going to add to the prime cost. Then we get our cost of raw material consumed. When we are going to get the answers. Then after that, we subtract expenses. We are talking about expenses carried outward, rent paid, discount allowed, administration expenses, distribution expenses, selling expenses, depreciation. Then we get the net profit. If there is a net profit, if there is a net loss, then we get the net. So this is the format for a manufacturing, trading and loss account. So, okay, there are some times when you are only required to do the manufacturing account. When you are asked to do the manufacturing account, then we only end on this slide. Okay? But if you are asked to do the profit and loss, then you add this other information for you to determine if the company have made a profit or a loss. So this is a manufacturing account, the one you are looking at now. That is a manufacturing account. Then you start opening stock. Maybe before you started producing, there was some stock available that you started off with. You add purchases of raw materials that you added because the previous one that you found won't be sufficient to cover the production. So you added new, that is purchases. Then you add carriage inward. Then you subtract the closing stock of raw material. Then you add labor, direct labor, loyalty, then you get your prime cost. From your prime cost, you add factory overhead expenses. Then you are done with your manufacturing account. Okay, it's only when you are asked or required to do your income and profit and loss account where now you are going to less expenses of your company. Then that's when you are going to do that. Okay. Thank you very much. So this sounds like it's a lot of work, but it just requires practice. Practice make perfect. So if you are practicing all the activities that are in your modules and you are following all the instruction, all the guidelines that are in the slides, then accounting is the simplest subject. It can only be difficult if you are not putting more effort. So nothing comes easy. So what I want to tell you, study very hard and all the best.